Big tech dominated the earnings story this week with top tickers such as Meta, Alphabet, Microsoft, and Snap all reporting. Yahoo Finance had you covered from every angle, breaking down the numbers and hearing from the company leadership, as well as Wall Street analysts to help you better understand the report. Here's a look back at some of the top moments. As we all know, the company released its second quarterly earnings, seeing strong revenue and profit beat. The automaker also upped its profit forecast for the second time this year. Yahoo Finance's Prasad Subramanian, who has been listening into the conference call to give us some more details here.
Yeah, you just said it there. Revenue up 25% there year over year, $44.7 billion, $1.91 adjusted EPS. GM upping that profit guidance for the second time this year, talking about how extracting costs and sort of higher MSRPs helping to boost that bottom line. Here's Mary Barra talking about that just earlier today.
We have now delivered 4 consecutive quarters of higher retail market share in the U.S., and our total share was up almost 1 full point in the first half, with strong pricing and incentive discipline. We lead the U.S. industry in both commercial and total fleet deliveries calendar year to date. We now have led the U.S. industry in initial quality for the second year in a row. We are focused on strong cost discipline, and we are taking additional steps to lower our capital spending. All of this impacts the bottom line, so we are raising our full-year earnings, free cash flow, and EPS guidance for the second time this year.
So they're finding a lot of that cost extraction through these layoffs they had announced before that they call the sort of voluntary buyouts. And then also stuff like marketing costs, travel costs, things like that.
And what's the vibe, Praz, around electric vehicles? Because we heard GM this morning call out they're going to make 100,000 EVs potentially in the second half of this year, bolt on to the 50,000 they made in the first half. 150,000 for a company that was struggling to get these to market. It's not too shabby.
Yeah, I think there was a little bit of a hiccup there because they talked about how they had 50,000 EVs this year, first half, 100,000 next for the second half of the year, and then eventually 400,000 by the end of 2024. But I think there's some concern about the battery modules and getting those up to speed. Mary Barra addressed that, and she said it was kind of disappointing to see that ramp up.
We've also added additional lines because we don't want module production to gate our launch of all the products that we have coming in the second half of this year and continuing into next. And we know we're going to need that module assembly capability anyway as we continue to grow beyond the 400,000. So disappointing. I've personally been reviewing the lines. As you know, I spent time in ME earlier in my career running it. So we'll get this behind us. I'm very confident of the teams we have in place. You'll see it improve as we get through, I would say, into the end of third quarter, beginning of fourth quarter, and then I think it will primarily be behind us by the end of the year.
So some bad news, but good news. The Chevy Bolt's coming back. They announced that.
Is that good news?
I mean, it is their by far and away top selling EV, right? So it's going to come back as a next gen model using the Ultium platform. So that's going to be there. And I think all eyes are on them to execute for the next back half of the year with the Silverado, the Blazer, and then also the Equinox coming out too.
Big names here reporting. We are seeing stocks moving in the opposite direction. Let's start with the one that's under pressure here. Microsoft, we're seeing a beat on the top and bottom line here, but it is about the decelerating growth here, particularly around cloud. What's your takeaway on that front?
Well, first of all, Azure was the main focus here. They had guided 26 to 27%. They came in at 27%. I think a lot of people were looking for a higher number, deliver on Gen AI, on loads of Gen AI. It's very obvious that the enterprise now is still in this optimization stage of looking at their cloud spend. So that's a little bit disappointing, and people are looking at a higher number there.
Is it unrealistic of investors to expect, though, a monetization of generative AI this soon in the game for even a powerhouse like Microsoft?
That's the right point. But, Satya has been very, very aggressive in his narrative on OpenAI. And I think people were looking for a little bit better on those loads. Generative AI it's not a flip of the switch. And you ask the right question. These are re-architectures of data stacks and infrastructure, and it does take a long time. So, you can look out about a year out and you'll start to see it hit the model, but there is a fair amount of high expectations with Microsoft being up 46% year to date.
Yeah, and Ted, you could argue maybe a slight pullback is needed given the excitement.
Healthy.
A healthy pullback, we should say. When you look at Microsoft, always a good pulse of just where enterprise is spending right now. Given the deceleration we've seen on that front as well, what does that tell you about where companies are putting their money?
I think this is the optimization trade. Everybody's really looking at their IT budgets pretty aggressively. That's nothing new. With our conversations with CIOs, Microsoft is kind of the Death Star of technology. They are swimming totally out of their lanes. They're innovating faster than anybody else. They're using their $17 billion cash flow per quarter to really integrate AI into areas like development tools on GitHub, which I think is going to be very strong, as well as moving into security. So when I talk to CEOs or our analyst tech team talk to CEOs, one thing comes out. Microsoft is becoming a line item in budgets. And I think along with every single company in tech, those IT budgets are not infinite, especially in 23.
I think something that you just alluded to is really noteworthy here, in that we've moved past this kind of hype phase or narrative selling cycle, or part of the cycle for generative AI, and for a lot of tech companies and even non-tech companies that had said that they were going to be able to benefit and leverage from it. No doubt that could be true, but now that we're in the prove it phase, how many other companies kind of across the spectrum here could be set to face some tough questions from investors and ultimately perhaps see their stock prices react in tandem?
That's the right question. I mean, I sit on over 70 calls a quarter on tech, and I'd say 90% of the CEOs are saying they're generative AI companies. Some are, and some are somewhat imposters. And I think you're going to see the companies where the emperors don't have clothes, and then the companies taking massive share. It's more of a platform sell, and there's some infrastructure picks and shovels that are going to do extremely well. But not everybody is going to catch this wave. It takes a lot of free cash flow and a lot of engineers.
Finally, Ted, we're watching shares of Alphabet moving in the opposite direction. Certainly a number of things to hit on in terms of what investors are watching there. It is the monetization of their AI technology. It's also about the growth they've seen in YouTube and digital ad spend. What's the one that you think really is leading to these gains? I mean, to what extent is a 6% pop here justified?
It's, if you look at Google, Google's up, I want to say about 39% year to date. So it's a little bit below the Microsoft gains, but it's all advertising. Advertising last quarter was somewhat muted, and this improvement on advertising is noteworthy. Also, I think if you look at GCP, which is their cloud offering, it's solid growth of, call it 28%. So they're one of the big three between Amazon and Microsoft, and very, very poised from a cloud standpoint. It's an engineering company. And I think some of the Gen AI, privates are using GCP because it's much more flexible on APIs. And quite frankly, they've been a pioneer for a long time on AI infrastructure.
Just lastly, while we have you here, Ted, I mean, the street has become used to hearing from Ruth Porat in one facet or another, and now there's going to be transition as the search commences for a new chief financial officer. What do you believe this next iteration of that position particularly could hold? Is it one of kind of extreme cost measurement, even more so than Ruth has done over the years, and having to monitor where some of that spend is going out the door and where they're able to monetize very well-oiled parts of their business?
She's one of the best CFOs in the business, if not, the top 5 CFOs in the business. And the investor community had a tremendous amount of trust with her. She was very much of a straight shooter, and and quite frankly, had a very good command of the numbers. So the person coming in is going to have to be that type of person. CFO communication is key with the institutional market, and Google's going to have a hard role to find to really take advantage of having Ruth in the seat for so many years. It's been a blessing for the company. She's an all-world CFO.
Certainly have been at the helm, the steady hand at the helm for many, many years. Ted Mortensen, it's good to talk to you today. Appreciate your insight.
Shares of Snap, they are plunging right now by about 16%. We'll round that off to a little more than 15% right now after reporting earnings. Ali Canal is here to break down the numbers for the brand of Ghostface Chilla.
Yes, and this share reaction is largely due to forecasts that came in weaker than expected. But we did see a beat on both the top and bottom line. Revenue coming in at $1.07 billion versus the estimated $1.05 billion. Now that's a decrease of 4% year over year, and it marks the second straight period of declining year over year revenue for this company. We did see a narrower than expected loss for adjusted per share loss of 2 cents versus a loss of 4 cents that was expected. Global daily active users also beat estimates, 397 million in total, whereas average revenue per user, another beat there, $2.69 versus the expected $2.67. Now, when we go to the forecast here, they do see third quarter adjusted EBITDA losses to amount between 50 million to 100 million. That's assuming that the company's daily active users will reach between 405 million and 406 million. Now, Snap has been aggressively trying to reshape its business. They said they're going to continue to invest in AI, other infrastructure to improve the performance of its ad platform and drive deeper content engagement. A lot of the experts we've been speaking with have said content engagement is going to be key, especially with those younger consumers like Gen Z and millennials. On the call, I'm sure investors will be very tuned in on the health of Snap Plus, what those subscriptions are like, how that could add to average revenue per user. Snap, I should say, also saying that the forecast assumes modest sequential headcount growth as we continue to carefully calibrate our operating investments to focus on the inputs most essential to the acceleration of top line growth. Again, that's Q3 adjusted EBITDA expectations between 50 million to 100 million there.
You know, this is a company that could face a ton of questions on this earnings call, just looking at the stock reaction. And as investors and analysts who are going to be pegging the executives with questions on that call when they get the chance, I think back to the previous earnings call that took place when Rich Greenfield was asking them the question of, should you be scaling back the purchases or at least the capital that you're expending right now on even some of the augmented reality features that you're putting into this platform? And it's a larger question of the cost restructuring that may need to continue to take place. Snap, I think, had pushed back saying we already put much of that forward, so we're confident now in the way that we are moving and in how much we're spending and in where that goes into different AI chatbots on the platform, or whether that is to enhance the content experience too. But in these screen wars, Snap had acknowledged years back that everybody from Netflix all the way to a TikTok is their competitor. And that's a wide range of people that are vying for consumer attention right now.
Yeah, instead, not always really kind of assessed or valued. It's sort of, the tech play as in, they were very ahead on AR. They have been incorporating AI as well. It's not necessarily valued the same when you compare the excitement around it. Should note, by the way, Meta shares up nearly 2% here now and after hours too, because it's interesting always to see the reaction between what's been playing out in Snap tomorrow, Meta reporting. That stock though, maybe in reaction to what's happening with Google as well and digital ads there, but up nearly 2% right now.
Just one last note here. We've been looking at the plusification of everything, essentially. Snapchat Plus, their subscription service that offers exclusive, experimental, and then additionally pre-release features that reached 4 million paying subscribers in Q2. That's 1 year after launch, they're noting here as well. So perhaps we'll get a little bit more color about that and what their pricing strategy might be in the future as well.
Competition's still a big question.
Yeah, exactly.
Big concern.
Yahoo Finance's own Ali Canal joining us to break down some of the numbers this afternoon. Thanks so much, Ali.
shares of Snap plunging on third quarter guidance despite beating on earnings. For more on this, we turn to Scott Kessler, Third Bridge Global Sector Lead for Tech, Media, and Telecom. Scott, good to talk to you today. A huge decline is what we're looking at, down more than 17% here. What do you think? What's the street not liking?
Look, this is not surprising. I think Snap has got to be one of the more volatile names within this category and even across TMT in conjunction with quarterly results. I think it's really more of the same. I feel like I've seen this movie at least once or twice before, where Snap essentially is indicating that there are some challenges. The challenges could be coming from the macro backdrop, could be coming from the fact that, they've been overhauling their ad technology and platform, or the fact that it is in fact a very competitive market. All that put together means that there are, I think, continuing issues that Snap has to overcome, and investors are not especially patient, especially at this point.
Scott, you read a report like this, you see the share price reaction. Sure, year to date, they're up by about 40%, but with all of the competitive factors that are in the market right now and the ways that consumers' attention are being pulled in one direction or another on either user-generated content or just consumption of that content, can investors still feel comfortable holding Snap?
To be honest, I don't know how people can feel comfortable, especially given the implied decline in the share suggested in the after-hours trading. That being said, however, I think it's appropriate to kind of wait and see in terms of what the company has to say. Look, the company announced a pretty major restructuring a little less than a year ago. I think it was August of last year. They talked about prioritizing, things like user growth and revenue growth and essentially AR, VR, presumably monetizing that. They're focusing on those things. But really, to be able to truly execute, they need to be able to get their advertising technology and platform in place. And it's taken them a lot longer than people might have expected. And it's had a negative impact on their ability to kind of drive monetization. And that's what people want to see at this point. I think that the company would be well advised to hopefully indicate that they're in position to kind of relaunch the ad platform so that they can really benefit from what historically has been a really strong period for them, and that's the holiday shopping season. So we'll see what they say there. In
prioritizing some of those features, Scott, at what cost, though, here? Because it seemed like in the previous quarter, that was the question that many analysts got ahead of. How much are you willing to spend to continue to prioritize some of these efforts, knowing that you're in a corporate advertising spend slowdown or kind of lull period?
Yeah, look, I think these are things that they need to do. They've already embarked on this spending, so they can't just stop midstream. Nonetheless, I do think it's reasonable to ask, when is this going to be done, and when are you going to start being able to, flip the switch and be able to really capitalize on the investments that they've been making for a number of quarters at this point? I think those are very reasonable questions. I also think that people should be wondering about other monetization efforts. We spoke with an expert not that long ago who pontificated that, yes, monetizing Snap Map is an opportunity, maybe a priority, but not something that we should expect until next year. I think sometimes with Snap, it seems like there's a lack of a sense of urgency coming from company leadership. We clearly saw that urgency when the company announced a pretty massive restructuring last August. But since then, I think people are kind of wondering when the benefits of that restructuring are really going to manifest themselves.
And Scott, we didn't even get to the competition discussion of all of that, but certainly a lot to talk about when it comes to Snap stock. Scott Kessler, appreciate your time today.
Thank you.
shares of Microsoft under pressure in after hours here, down now more than 2%. When you look at the numbers, a solid beat both on revenue as well as earnings per share, but it really is about the outlook here for the company and concerns about continued slowdown in investments. So let's walk you through the numbers here. Revenue coming in at $56.19 billion, earnings per share at $2.69. Some numbers we like to look at in terms of where things stand. Intelligent cloud revenue at $23.99 billion. That's also a beat pretty close to where estimates were. We're also seeing operating income coming in at $24.25 billion, CapEx at $8.9 billion. One thing that we've been watching, on the one hand, there's been an excitement around AI and Microsoft's investments there. There's also sort of where their core business has been, and that has been in enterprise here. When you look at revenue and more personal computing, that came in at $13.9 billion. It was down 4%. Windows OEM revenue decreased 12%. And that's something that we have heard in terms of companies increasingly sort of maybe pulling back some of their investments in the face of what is more of kind of a cloudy outlook on the macro front. Now, the big question here going into the call is going to be, well, how are they going to be monetizing AI? What does that growth prospect look like? Satya Nadella in the release saying organizations are not only asking how, but how fast they can apply this next generation of AI to address the biggest opportunities and challenges they face safely and responsibly. He goes on to say, we're focused on leading the new AI platform shift. Is that going to be enough to really get investors excited beyond what has already been built into the stock here and the potential for additional growth coming from AI technology?
No, it's a great point. And I think as we were talking about this earlier, coming into the report, it's really going to be about how much on the call they disclose about the level of spending that they're comfortable continuing to put forward, whether that's investments in other entities like OpenAI and whether they add incremental investment on top of that, considering the head start out of the gate that OpenAI has had in some of their research development and actually bringing a product to market that everybody and their grandmother is talking about. If they're at the summer barbecue, everybody wants to know about ChatGPT. And so at the end of the day, for Microsoft now, where do you further that investment into some of your other tentacles that you have that round out this holistic MSFT umbrella here, whether that be AI within LinkedIn, whether that be AI within some of their advertising products within search engine as well. Investors want to hear the answers about when that's going to be monetized and when that trickles through to some of the margins too.
Yeah, and we did kind of get a preview of that, right, when Microsoft announced some of their pricing strategy last week, $30 a month in terms of use of their generative AI with their Copilot service on top of what companies are already paying. Yeah. So we're getting a glimpse of how enterprise customers are wanting to integrate that. It is about how quickly that growth will come and how quickly the revenue is going to come in.
Yeah, spot on here.
Earnings season kicking into an even higher gear with Microsoft and Google parent company Alphabet kicking off big tech earnings this week. Microsoft's fiscal fourth quarter earnings beating on the top and bottom line. The tech company's overall revenue up 8% to just over $56 billion. Analysts had expected closer to $55.5 billion. The shares, though, are down as the tech giant reported that Azure and other cloud services revenue growth of 26% year over year was a deceleration, and that's really what the street is focusing on. Brad, for after the call, you listened to that call. So what were your impressions?
Yeah, listened to the call, combed through the transcript as well, and looked at the reaction and where particularly investors and analysts were really not impressed here. Now, a few things going into this report that we were going to be listening for. Of course, we're past the perhaps lion's share of the AI or generative AI hype phase. And so now we kind of pivot into this, well, prove it part of the narrative here. And so for Microsoft, one of the things that I was keyed into was this that they had to say on the call. This from CFO Amy Hood, who was talking about the first half of this year in comparison to the second half and where some of that capital cost structure is going to be moving. Let's run a clip of this.
At a total company level, revenue growth from our commercial business will continue to be driven by the Microsoft Cloud and will again outpace the growth from our consumer business. Even with strong demand and a leadership position, growth from our AI services will be gradual as Azure AI scales and our copilots reach general availability dates. So, for FY24, the impact will be weighted toward H2. To support our Microsoft Cloud growth and demand for our AI platform, we will accelerate investment in our cloud infrastructure. We expect capital expenditures to increase sequentially each quarter through the year as we scale to meet demand signals.
And so as we're in kind of the prove it portion of this AI or generative AI investment strategy for a lot of the major tech companies, especially in the search engine part of the economy or the broader markets out there, I should say, one thing that is going to be important, amazingly important for investors to pay close attention to is how much companies are willing to continue spending on some of those AI efforts here. And that's what I was keyed into on Microsoft's earnings. Ultimately, for my vibe check for this call here, because I don't feel like I got some of that clarity or transparency, I gave this A, and here is the drum roll and also the graphic for you. A meh. It's Microsoft for me right now. And ultimately, because I did not get that clarity, I also think Ted Mortensen from Baird put it amazingly clear here in saying that generative AI is not the flip of a switch, and it's important for investors to remember that. We were able to discuss some of the earnings with him later yesterday, just after the results dropped.
Yeah, it looks like investors are on the same page as you in dubbing it Microsoft, because that's what we're seeing definitely from the stock this morning. Although, to put it in perspective, right, there was such a run-up in the stock going into the earnings here, and a lot of talk, as you and I know, going into not just Microsoft, but other big tech about the expectations being very, very high and about them really needing to deliver extraordinary numbers in order for the stock to continue to move higher. So it seems as though the assessment is they didn't quite meet that high bar.
Absolutely.
Investors aren't eating up Chipotle's earnings report this quarter as the stock is down 8.5%. The restaurant chain saw same-store sales rise 7.4% from a year ago, but that was below the average analyst estimate of closer to 7.7%. Chipotle did get a boost from prior price increases, with food, beverages, and packaging costs making up nearly 30% of its revenue. Chipotle CFO Jack Hartung is joining us now. Jack, it's great to see you as always here. I mean, 7.4% anywhere else would certainly be a victory. That's still big growth that you guys are seeing here. What do you feel like, if anything, didn't go right in the quarter, or do you think that the street is not getting it right?
Yeah, listen, we're really proud of the results in the quarter. We had, as you mentioned, strong comp at 7.4%. That was driven by over 4% transactions. Our margins were the highest margin we've had since 2015, and so we're really proud about that. And more importantly, we're setting ourselves up for future growth, not just in the U.S., but in international as well. We're investing in robotics. So we're really bullish about where we stand today and where we go in the future. Our stock has performed really well this year. And, it's still, even with this pullback, is up, around 35, 36%. So this might be one of those cases, Julie, where the stock just got ahead of itself. And, we don't think about our business or our stock in terms of a day or a week. That we think about it in terms of next year, the next 5 years, the next 10. And so we don't worry about short-term moves like this.
Well, one of the things, Jack, that your competitor, one of them, of many, of course, internationally, was talking about on their earnings call this morning was a change in consumer sentiment. Is that anywhere present, either in the results or even in your outlook right now, as you think about the different touch points that you have with so many different diners?
Yeah, we're not seeing it. Most of our business is in the U.S. And in the U.S., we look at our customers, not just overall, but we break it down by income levels. Last year, we did see the lower income consumer was pulling back a little bit, but they've come back and they're spending at just about the same rate as our higher income consumers. And in our case, I think what Chipotle offers to customers, both at the low income, the medium, and the high income, is that we're the kind of food that they want to eat. It's wholesome ingredients, sustainably raised ingredients. It's real cooking. It's food that they crave. And it's a lot of food for a very, very good value. So an environment like this, Chipotle is a great place for consumers of all spending abilities to join. And, if you're going to pull back on your budget, Chipotle's not, it's very affordable. So it's not something you have to pull back on.
Talk to us about the trends you're seeing then in terms of frequency of visits, in terms of size of ticket, for example, sort of related to what you were just talking about.
Yeah, we're not seeing any change in sides whatsoever. So the attachment of guac and queso and, chips and salsa and things like that are very, very consistent. The only thing we're seeing that is affecting our check is the group size is getting smaller. But that's really a continued return from this post-pandemic period. We're seeing that our urban restaurants are out-comping our suburban restaurants. That means obviously more folks are working from the office from home. And so instead of getting a meal with your family at home while you're working, you're at the office and you're getting it by yourself. So we're seeing a normalization of group size. Now, our group size today is still higher than it was in 2019. So we're, I would say, getting back to normal, but no indication that people are trying to spend less when they visit Chipotle.
And so all that considered, there have been some significant digital investments that the company has made, that you continue to make, and menu innovation kind of in tandem with that. Where is the biggest pickup that you're seeing right now in menu innovation, and what's on the docket next?
Yeah, so Chicken al Pastor has been fantastic. 1 in 5 customers is getting Chicken al Pastor. The beauty about Chicken al Pastor is, from an execution standpoint in the restaurants, it's very seamless. It's the same chicken that we serve normally, but it's got a different marinade, a very delicious, slightly spicy marinade with a little pineapple, a little pepper. So it's really, really delicious. So it's easy for our teams to execute. Our customers love it. It's been really our most successful LTO. We do have another LTO coming in the fall. Now, we haven't announced it yet, so I'm going to have to tease you a little bit. I can tell you it's not chicken and it's not brisket, but we're really excited about what's to come. And menu innovation is important because customers know that they can get real culinary, real cooking at Chipotle. And for us to have some exciting news just a couple times a year, we think is important to keep our customers excited about visiting and getting some variety.
Let the guessing begin. Not chicken, not beef. There are some other proteins. All right, Jack, we'll have to keep in touch with you on that one. Let's talk pricing for a moment. Where do you guys stand in the pricing cycle? I think the last time we spoke to you, you were definitely slowing down price increases. And on a related note, if I can also get you to comment on portion size, if you guys have decreased portion size as well.
Yeah, on pricing, we're coming on a year since we've had, our last national price action. That was in early October of last year. So we've held the line on pricing this year, and we've still been able to generate these, very, very strong margins. We have seen a little bit of inflation in some of our ingredients. You haven't seen it in our margins yet because we've had favorable avocado prices that have offset it. And also the idea of Chicken al Pastor, we actually are shifting some meat eaters, which is more expensive from a food cost and a margin standpoint, into chicken, which is more favorable from a margin standpoint. And as those things normalize, some of this inflation will come through. So we have talked about, we'll consider whether we need to take a modest pricing action later in the year. Portion sizes are not getting smaller. When customers come to Chipotle, they expect their burrito. They want not only the ingredients they want, but they want the portions that they want. One of the great things about customers that come to our restaurant, they interact with our customers. They get exactly what they want, as they move down the line. And from a digital standpoint, it's the same thing. You can order light rice if you want, or you can get X-Racer if you want. And you can do that throughout each of our ingredients along the way. So we're not going to try to manage our margins based on portion size.
Jack, want to go to kind of a holistic Earth type of perspective here, as we've already heard so much about scientists saying that this is going to be one of the hottest years on record. And when you think about that, as it relates to Chipotle, I think about sourcing. I mean, you're one of those companies that has been more vocal about the sustainability of your practices and getting ingredients and working with farmers to get more kind of farm to table or farm to burrito or farm to bowl, whatever that may look like. So do you look at some of the climate risks and factor that into how Chipotle is sourcing ingredients and continuously able to get them into the most kind of fresh environments to then be able to serve them up to customers? How do you kind of look at that as a broader put or something that you have to navigate?
Yeah. Listen, we do. And I wouldn't say it's necessarily just, based on climate or based on, the heat wave that we're seeing right now. It's really based on diversifying where we get our ingredients from. For example, we buy a lot of local produce, anywhere between 35 and 40 million, pounds per year. That's important for us to diversify where we're buying from. It's also important for our customers to know that the produce in your bowl today, was raised within a short distance of where the restaurant is. That's very, very important. It also supports local farmers when we do things like that. But then even beyond that, like avocados, for example, we've been diversifying where we buy our avocados from. So we buy from California and Mexico, and we've done that for a couple of decades now. But we're diversifying by looking in areas like South America, for example. And so we're working with suppliers that haven't been big sources of avocados in the past, but we'll partner with them because they know that we have the demand. And if we have the demand and we have an agreement with them, they can invest in building that capacity over time. So it's one of the areas where we're thinking about not just this year or next year, over the next 10 years, where are ingredients going to come from? And let's diversify from a supplier standpoint and from a geography standpoint, and then we'll be able to keep up with the significant growth ahead of us.
Jack, sort of on a related note, it's interesting, as Brad was asking that question, I got a news headline alert on my phone talking about July being Earth's hottest month on record. So, obviously this is a very pertinent conversation right now. I'm curious how, not just with produce, but all across the board, it affects your cost structure and how you think about that going forward, because obviously energy costs are a factor here as well when you have not just heat, but other kinds of weather events, not just for avocados, but really products across the board, right? I would imagine you would continue to see a longer term secular upward pressure on some of this produce. How do you think about all of that?
Well, there's one direct effect. Frankly, we're seeing our utility costs up. We signaled that in the third quarter, that our utility costs will be up. And also, when you have this kind of heat and you're putting this much pressure on your HVAC, you have breakdowns as well. So our M&R is a little higher as well. From a produce standpoint, from an ingredient standpoint, again, we don't know where the climate challenges are going to be. And sometimes it's, storms in a certain area of the country, or it could be heat in a certain area of the country. And so the best thing we can do is we partner, and we have long-term partnerships with our folks. Our partners know they can invest in their business, whether it's to expand capacity, whether it's to bring new technology so they can deal with some of these weather challenges. We also have the Cultivate Next Fund, which is a fund where we are working with, really early startup companies to figure out how can you diversify where and how crops are grown. So that, again, you can diversify and not be tied to just one geography. If one geography gets, hit by a weather event, whether it's a short term or a longer term, it's very difficult to source the fresh ingredients that we need to prepare our meals at Chipotle. So this idea of partnering over a long period of time so we can diversify and figure out what technology we can use to, think about not just today, but years into the future is very important to us.
Jack, thanks so much. I'm just blown away by our conversations quarter after quarter, and we appreciate you taking the time, as always. Chipotle CFO Jack Hartung, really appreciate the time.
Shares of Meta making big moves on upbeat earnings results today. The company beating the street's expectations on the top and bottom line. Meta also saw some recovery in the ad space, reporting ad revenue growth of 12% year on year. Mark Zuckerberg's year of efficiency showing some signs of paying off. Let's bring in Meta's Chief Financial Officer, Susan Li. She joins us from headquarters in Menlo Park. Susan, it is great to talk to you today. Really strong quarter here that points to a reacceleration of revenue growth. We're talking about 11% growth year on year, digital ad spend specifically 12% year on year. How much of this is about a meaningful rebound we're seeing in the digital ad space? How much of this do you think is specific to what Meta did?
Hi. Well, first of all, thanks so much, Akiko, for having me on the show. It's really great to be here. As you pointed out, this was a really solid quarter for us across broadly our user and engagement metrics, and certainly the reacceleration in revenue that you were pointing to. I'd say that, there are a couple factors that are driving the reacceleration in Q2 revenue, and that also flow into the guidance range that we gave for Q3. First of all, it's an easier compare, frankly, relative to where we were last year at this time, both in Q2 and Q3, and I'd be remiss not to mention that. Second of all, we are seeing stabilization in the broader macroeconomic landscape. And for us specifically in some of the verticals that we have higher exposure to, like e-commerce, retail, CPG, gaming, et cetera. So that's a place where we're optimistic that we're seeing signs of stabilization. And then more broadly, I think we certainly are seeing the execution that we have worked hard on over the last quarters and years, and the investments we've made in product work across both the core engagement side and the ads monetization side, paired with the GPU investments that we've made, play out in a way that I think we feel really good about in terms of contributing to our long run growth. So those are all factors that I think certainly played into the Q2 results on the revenue side. On the expense side, what I'd say is the year of efficiency, I think, has really set us up to be in a good place from a cost structure perspective going forward. It was a tough year, obviously, with a lot of challenging decisions, but we're certainly in a place where we have a leaner cost structure as we plan ahead. And we're also a faster, nimbler company. A lot of the work that we did was really in service of making sure that we're in a position to build more and ship faster and just deliver better experiences for all of the people who use our products. And the final thing that I'd say was a key theme from this earnings call was the early color that we gave into the 2024 expenses. There are a handful of places where we feel like there are compelling opportunities for us to invest in terms of infrastructure, especially around building out our AI capacity, hiring top-tier technical talent, and of course, our long-term vision in Reality Labs and the metaverse. So those are really the big earnings themes for us this quarter.
Yeah, and I want to get to some of those expenses in Reality Labs in just a bit, but when you look at the family of apps, you really did see significant user growth. The latest app out there, Threads, there's a lot of excitement around it. You made it pretty clear on the call that you're still a long way from monetization. But as you look at how to build out that particular app, how significant a revenue driver do you see Threads being in the future?
You know, we're really so early in the life cycle of Threads. I don't think we're at a point yet where we can talk about monetization. Threads is the new standalone app that we just released earlier this month. We're pleased with its user growth numbers and its retention, certainly for a new standalone app that we have just launched. And we're at a place where our focus is really on making sure that the consumer experience is as good as possible. There's foundational product work we need to do, features that users have asked for that we need to invest in. And then we have a playbook that we have executed many times across our history in terms of growing users, in terms of increasing engagement, stabilizing retention. That's going to be our primary focus for quite a long time to come until we're at a place where we feel like it makes sense to start thinking about monetization of Threads in earnest.
You getting some calls, though, from advertisers who are excited, maybe potentially moving away from X and looking at Threads as another opportunity?
I mean, I'm certainly excited about Threads. I am glad that advertisers are, but it's very early for us. We are very pleased, though, with a lot of the work that we've seen happen across Reels. That's a place where we've executed that playbook that I talked about across growing the product experience, increasing engagement, and ultimately monetizing in a way that's been really, I think, productive for both the people who use Reels and for advertisers.
You mentioned the expenses that are adding up. Operating losses for Reality Labs increased more than 30% year on year. And you've been pretty clear next year you're going to be spending even more. I realize this is a long-term play, but where is that investment going? And ultimately, where do you see the return? Is it more in hardware or more in software?
This is a really good question. So Reality Labs is a very broad portfolio for us. It spans a lot of things. I think what most people are familiar with is our VR products, the Quest and Quest 2 devices that we've had out in the market, which have really established themselves, I think, as the leading VR headset experience. We also have the Quest Pro device, which was our first mixed reality product, but we're bringing a much more broadly accessible mixed reality device, the Quest 3, to customers later this year. So that's the VR anchor. Now, as I mentioned, the Quest 3 is actually one of our sort of broader forays into mixed reality, which we think both is going to establish the standard for headsets going forward. It's also going to be an introduction over the longer term to AR devices. And AR is really, I think, the place where our time horizon is longest. It is really about trying to build towards the next computing platform. It's where a lot of the investment is going. We also have work, of course, developing the metaverse and social experiences related to the metaverse. And finally, neural interfaces. To your question on the time horizon for returns, it's really a very long-term time horizon, especially on the AR side. But as Mark talked about yesterday on the call, there's both an expansive product vision and a desire to be part of the shaping and the building of the next computing platform. But at the same time, we recognize that there's also a lot of business value that gets accrued from having a key role in really building the next platform. And that's something that we've learned, being built on other platforms right now. So even though there's very much a strong product vision that's underpinning this, at the same time, it's really built towards unlocking a lot of business value over this time horizon also.
A lot of excitement around artificial intelligence. Meta has talked about the use of AI, especially within advertising for some time. But now there's a lot of excitement around Llama and generative AI. How do you see that technology being applied from a consumer standpoint, from a user standpoint? How do you think the experience shifts as a result of this technology?
Yeah, so we've been investing in AI for a long time, but historically more of the emphasis has been on the core ranking and recommendations work that has powered our feed, our ads, the existing consumer experience and advertiser experience. What we're looking ahead at when we talk about the Gen AI work that we're doing is really around how do we make it easier for people to create better, more individualized content. That's true for both creators and for advertisers. How do we enable people to have conversational experiences with AI that are going to enhance different parts of their experience? And how do we enable businesses to talk to and communicate with consumers more efficiently and more productively than they do today? And we think that across all of those dimensions, there's going to be opportunities for us to build out new product experiences and features for our users and for advertisers that we hope will be really valuable. But that's all very, very early. It's not, for example, a part of our revenue guidance in Q3. It's something that we're really thinking about more in the future.
Finally, Susan, something that both you and Mark touched on very briefly in the call yesterday, which is the tough regulatory environment we're seeing in D.C. right now. Today, we've got Senator Elizabeth Warren as well as Lindsey Graham coming out and calling for a federal agency that essentially cracks down on tech. When you look at the environment right now, to what extent does that tie your hands in terms of acquisitions, in terms of capitalizing on the opportunities? How much does that slow down your vision for expansion, knowing the checks that are now being put in place from a regulatory standpoint?
It's a good question. First of all, on the regulatory side, what I'd say is we've been navigating a challenging regulatory environment for some time now, and we're always focused on working productively with regulators to establish frameworks that help protect people while at the same time not stifling growth or innovation. So that's something that we're very focused on, and we want to make sure that we're engaged with regulators productively. It's a big focus. On the second part of your question, we've got a lot of organic opportunities to invest in. We talked about the investments in AI. That's a place where we're going to be building out a lot of experiences ourselves. Same on the Reality Lab side over a longer time horizon. So while we're always evaluating the broader M&A landscape for potential opportunities for us to expand via acquisition, at the same time, I think we've got plenty of things that we can work on organically that are really compelling investment opportunities for the years ahead.
Meta CFO Susan Li, really great to talk to you today. Appreciate your time.